Welcome back. Before we take a look at the day's business news, let's take a look at the stock indices across the GCC. Fines for importing fake goods into GCC countries will increase to the equivalent of 1 million dirhams from next year under a new GCC-wide trademark law. The director of the Trademarks Department at the UAE Ministry of Economy, Fatima Al-Husani, was quoted in a local report as saying that the legislation was due to come into effect in early 2014 and would help combat the multi-billion-dollar counterfeit industry. With more than 13 million containers passing through Jebel Ali port each year, mostly from east to west, Dubai in particular is a major thoroughfare for fake goods, including clothes, pharmaceuticals, electronics, watches and handbags, although it is not recognised as a significant manufacturer of such items. Presently, Dubai law allows for fines of up to 10,000 dirhams for importing fake goods, but there is no federal legislation governing customs in the UAE, with each of the 7 emirates creating their own regulations. Al-Hassani said the new GCC law would unify not only the UAE procedures and penalties, but those for all the 6 Gulf Cooperation Council member countries, and also will provide a specific article specifying customs authorities' role and powers in intercepting counterfeit goods. National Bonds Corporation has announced the results of its 2013 Savings Index for the UAE and GCC, indicating a noticeable increase in the prospects of saving amidst an increasingly favourable financial climate in the country. The National Bonds Savings Index includes the results of a comprehensive annual study that tracked the saving and spending habits of 1,707 UAE and GCC residents. In a departure from its previous surveys, National Bonds for the first time collated the responses of over 200 workers with a monthly income of less than 3,500 dirhams. Taking into account the 3 key factors of financial stability, potential for savings and the existence of an enabling savings environment, the study indicated a marginal decrease of 3% in the volume of savings among the residents of the UAE from 2012. The National Bond Savings Index also revealed that 22% of the respondents in the low-income category in the UAE managed to save at least 10 to 20% of their monthly income, with 31% of these participants either saving regularly or on a monthly basis or every 3 months, which is relatively higher than the rest of the community groups in the UAE.
We in National Bonds, because we cater towards all segments of the society, we've seen that we must shed some light on this neglected segment of the UAE community, and we were actually positively delighted with the outcome of the survey, because 38% of them said that they save regularly every month. Now, compared with the other groups that we have in the society, much higher earning groups, they are saving a much higher percentage, and that was a positive thing. Now, if you say why, because the reason number one is that they are not accompanied by their families, most of them, because they are below 4,000 dirhams. The other thing is that they have a very focused objective of supporting their families back home. That's why they keep saving a chunk of their salaries every month and remitted back home or invested here in the UAE.
As a key highlight, the study showed that 89% of the respondents in the GCC states expected financial stability throughout the next 6 months. A majority of respondents agreed that a significant portion of their expenses were dispersed on foodstuff and house rents. The study additionally indicated that 20% of the GCC respondents currently saved 11 to 20% of their overall monthly income, while 4% of them saved 51 to 60% of their overall monthly income.
Well, if we compare with the GCC, UAE came second after Qatar, if I'm not mistaken, in terms of the positive savings sentiments. If you compare the UAE to countries, like Japan and other places, Of course, no, we are way behind in terms of the percentage of savings that people save regularly. And here we talk about regular savers. They are only 2% of them said that they have more than what they planned for in terms of savings. But 86% actually said that they have less than what they did last year.
Global financial markets were range-bound amidst tight trading conditions in the lead-up to this week's FOMC rate decision. In its last meeting of 2013, there is uncertainty over future Fed plans with regards to their current $85 billion a month easing program. With an ever-improving flow of US data, market participants are increasingly expecting a taper to be introduced when the FOMC announced on Wednesday. However, dovish undertones emanating from some of the top Fed members point to a taper in March 2014 rather than this week. To talk more about this, we earlier spoke to Gaurav Kashyap, the head of futures at Alpari Middle East.
Well, we saw the US dollar put in a mixed performance last week. Trading conditions were relatively light, considering investors were on the sidelines in the lead up to the FOMC rate decision due out this Wednesday. Now, by far, the FOMC rate decision and announcement with regards to the taper will be the largest one piece of data which will drive price volatility throughout the rest of 2013, and it will set the trend for the first quarter of 2014. Now, expectations are a bit mixed currently. There are analysts who are expecting a cut of between $5 to $10 billion to their current Fed's easing programs, which could be announced this Wednesday. But overall, we maintain our view that the Fed cannot look at introducing the taper, and this will more likely happen towards the end of quarter one in 2014. Look, we've had improving jobs data from the US, we've seen improving GDP figures, but overall the business investments and consumer sentiment still remain too low for the Fed to look at even introducing this taper come their next meeting on Wednesday. Overall, if we do see a surprise taper, this will be very, very positive for the US dollar. Commodities will move lower against the greenback. We could see gold testing 1180. The euro and GBP will also move lower against the US dollar in the event that they introduce this taper. But overall, if we move with our expectations of no taper, then the US dollar will remain on the back foot. Equity markets will get a nice boost higher, and we could see the euro consolidating above 138, and gold could look at moving above 1270 levels in the week ahead.